Economic headlines can feel overwhelming, especially when they involve interest rates and housing. Did you know banks often move before the Reserve Bank does? Recently, some Australian banks have lifted fixed home loan rates and increased term deposit returns, even though the RBA cash rate hasn't changed. That doesn't mean a rate hike is locked in. It means banks are managing risk. Most people assume banks only move when the RBA moves. But banks don't price loans based on today's cash rate alone. They price based on uncertainty, funding costs, and how to stay resilient across different economic scenarios. That's where the disconnect often comes from. Inflation in Australia has come down from its peak, but it remains above the Reserve Bank's long-term target range. Progress has slowed, services inflation is still sticky, and wage growth continues to be monitored closely. This puts the RBA in a cautious position, and banks plan for caution, not certainty. When banks lift term deposit rates, they're encouraging customers to lock money away for 6 or 12 months. That gives banks predictable, stable funding and reduces reliance on more volatile wholesale markets. In uncertain environments, certainty has value, and banks are willing to pay for it. Fixed home loan rates often change before variable rates. That's because fixed rates reflect longer-term funding expectations, not just where rates are today. So seeing fixed rates rise doesn't automatically mean variable rates are about to change. For households, this environment isn't about reacting to headlines. It's about focusing on three fundamentals that actually influence financial outcomes. The first is income stability. Mortgage pressure usually begins when income becomes uncertain, not when rate change. Stable employment or reliable business income makes households far more resilient to economic changes. The second is cash flow buffers. Savings, offsets, or redraw facilities provide breathing room when conditions shift. Buffers don't remove uncertainty, but they give households time, and time reduces stress. The third is understanding how banks manage risk. Pricing changes are often about preparation, not predictions. When you understand how banks think, rate movements feel less alarming and more logical. Economic conditions change. Clear thinking matters more than predictions. This video is brought to you by TripleOFinance, your home loan and finance specialists. If you found this helpful, you're welcome to subscribe or share it with someone who may benefit. And if you'd like to discuss your home loan options, you can contact our team on 1-800-000-346. Thank you for watching.